सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Welcome all in this 7th webinar in sectoral series under GST, and we have with us our worthy torchbearers from WRC, Chairman CA Ketan Sayya sir and Vice Chairman CA Piyush Chandak sir, Treasurer CA Dr. Fenil Shah sir. With this, now I request our torchbearer to have their words of wisdom for all of us. Thank you very much.
Requesting Piyush Bhai, the Vice Chairman, to address all of us.
Thank you, Chairman sir. So, as I say, Bishan Bhai is giving us the opportunity again and again to congratulate him on behalf of WIRC and all the regional council members that he is conducting various different kind of seminars and projects under the guidance of Ketan Bhai and with the support of all the regional council members and his vice chairman, committee vice chairman. So I feel that GST, as the law is ever changing, we are like facing various difficulties day by day, and whenever we go for the sector specific, there will be some new notification coming out anytime, anywhere, and we have the worthy faculties also to guide us. So the role of WIRC is to bridge the gap between this knowledge bank and to the knowledge seekers, and that is how our regional council members like Bishan Bhai are working hard for this purpose. And I congratulate him again, and thank you for this opportunity. Over to you, Chairman sir. Now.
Thank you, Piyush Bhai. Thank you, Bishan Bhai. Jinesh, sincere thanks to you for your valuable time given to WIRC on this sector specific series. I think, wherever transactions are happening in e-commerce, the taxation always remains a big question mark. Whether, what is the place of services, how it will be taxed, be it, income tax, be it indirect tax or direct tax. Yeah. Today we have, in the form of Jinesh Shah, who's got hands-on experience of working into this area, and we are fortunate to have him here, and a lot of other sectors are also being discussed in this entire series, and I think this is going to go a long way. The entire series videos are uploaded on YouTube of WIRC. If any of you have missed any session, you may please go to the YouTube of Western India Regional Council and hear all the worthy speakers on different sectors. Tomorrow is last day for early bird for the regional conference, which is happening on 19th and 20th December at GO. The cost of conference is almost 10,000, and at an early bird of 4,500 rupees, the same is being hosted currently till tomorrow. Requesting member to take advantage of that. Also, inviting all of you to the WIRC ICI Tower for flag hoisting tomorrow, which is scheduled at 10 a.m. in the morning, followed by a spiritual lecture under the Promoting of Work-Life Balance Committee. We are going to have a session on improve your thoughts to improve your life. So requesting all of you and inviting all of you to attend both the flag hoisting as well as this spiritual session, which is much needed in current times of stress to all the professionals. With this, thanking each one of you for joining online, and thanking Bishan Bhai for taking a lot of efforts on the entire series, on all the initiative of GST committee. I think he is one such strong pillar in regional council who's working very, very hard from the day one till now. Multiple events are hosted. In fact, today we had this is back-to-back second event of GST committee. We've just started some time back with the GST help desk session at around 4:30, and now we have this industry specific. So without any of the rest, he is working so hard, and this is first time I am seeing that any committee having two program back to back, and both the programs are well attended by the participant. So heartiest congratulations, Bishan bhai, for all
Thank you,
unique
sir.
efforts which you are putting in the indirect tax committee. Thank you so much. Thank you to the coordinators also for helping us for the session. Thank you so much.
Thank you very much, sir. And we just, see you how restlessly, selflessly you are working for the region along with the team. And absolutely, with the vice chairman also, Piyush Bhai. So we seen you both, and that is what a motivation for all of us. And sir, since you are from Bombay, I seen you attending BKC every day. I don't know what happens to your office, but you are there for all of us, serving the region. So big kudos to you, and you are our inspiration, sir. Thank
Thank
you
you, sir.
so much for giving us this vision, and under your leadership all these things are possible. So now taking this webinar of today's topic, e-commerce and FMCG, we are having with us Jinesh bhai. I request Shivani madam to please introduce our learned faculty of the day.
Yes, sir. So, hello everyone. Myself Shivani, and good morning everyone. It is a warm welcome to all the participants for joining us today for the wonderful session. And this is the seventh series, the industry specific, that is virtual, and it is organized by our beloved VR WRC. So, I like to extend my gratitude towards the chairman and vice chairman, both of them. Really thank you. And let's start with CS Jinesh Shah, sir. So he qualified in May 2016, and he's a fellow chartered accountant. And not only that, he's also law graduate and commerce graduation from NM College. And he's currently manager in indirect taxation in Jaintlal D. Thakur and Associates. And without wasting time, let's start with CA Jignesh Shah, sir. So it's over to you, sir. Thank you.
Yes. uh, and on so far as this topic is concerned, e-commerce and FMCG, so it's a composite session. That is what I feel, because services are there and also goods are there. So Jinesh bhai, and I am very sure you are the expert so far as the domain is concerned, and please take us to all the complexity which we are facing in resolving uh, issues of our clients in these two sectors. So we welcome you, and a big round of applause for Jinesh bhai. Thank you. Thank you. Over to you, sir.
Thank you so much, Bishan sir, for your kind words. At the outset, I would like to thank Ketan sir, Piyush sir, Chairman, Co-Chairman of WIRC, and Bishan sir, Chairman of Indirect Tax Committee of WIRC, for giving me an opportunity to express my views on these two sectors, e-commerce and FMCG. As sir already said, there are two separate sectors, both of them not being so connected. And in GST, we have separate set of provisions for e-commerce, including registration, payment of tax, TCS. So the modus operandi for today's session would be, I would take you through the basic provisions of e-commerce, what are the nuances involved therein, and thereafter going to FMCG, we have the provisions which are common for all the SSEs, registration, composition, ITC. So we would not be focusing much on that, but we'll be going through the issues which are being faced by players in FMCG sector. So with that, we'll start with today's session. Sir, my screen is visible, right? So starting with e-commerce sector, we all know that, this is a recent phenomenon. E-commerce has given a lot of convenience to us. We can just order, a thing like a headphone to an air conditioner within 10 minutes and they are delivered at a place. We can order our favorite food from the favorite restaurant and, less than 20-25 minutes, they are at your place. So, it's a ever evolving sector. A brief background to this sector, it has, recorded $125 billion of revenue in 2024, growing at a CAGR of 15%, which is, quite striking. While I was researching, what actually, was wonderful that, tier two and tier three cities are dominating this. Almost 55 to 60% of e-commerce transactions are happening in tier two and tier three cities. So that is something which is really remarkable. Obviously, with increasing internet penetration, and government initiatives like UPI, Digital India, this sector is just growing at a really fast pace, and it is also creating, a good number of jobs for the youth, and almost around 15.8 million jobs were created in this sector. So, with this brief background, we go ahead. What are the types of e-commerce business model that we see? It's generally, three types of models that we see. First is your marketplace model, where different sellers register themselves on platforms like Amazon, Flipkart, OLX, and they sell their goods. Second is an inventory model where companies like Tata Click, Pantaloons, they aggregate inventory from various vendors and they sell it through their websites or their mobile application. And third is an aggregator model where businesses like Uber, Ola, Oyo, Swiggy, they all gather individual and businesses who are willing to provide their services through such platform. So these are three general models that we see in e-commerce sector. Coming to GST, we have specific definitions for e-commerce and e-commerce operator. The first one is e-commerce defined under Section 244 of GST Act. It is an inclusive definition which includes all kind of supply of goods or services and not limited only to digital products. So your tangible goods like clothes, electronics, etc., services, or even your digital project like software downloads, ebooks, etc., are covered in this definition of e-commerce. The main essence of this definition is the mode of delivery. It's not physical, it is something over a digital or electronic network like websites, mobile applications, and online marketplaces. Coming to the next definition that we have is an electronic commerce operator. It can be any person. We have a definition of person in GST, which means individual, LLP, companies, even foreign companies are covered under the definition of person, who own, operates, or manages digital or electronic facility. So, there are three limbs to it: who owns, operates, or manages it. So electronic commerce operator need not be a person who actually owns. A person who's managing an electronic platform can also be termed as an electronic commerce operator under GST. And obviously, that facility or platform should facilitate your e-commerce, which we have already seen the definition. Now, coming to the first set of provisions for e-commerce and e-commerce operators, we have registration related provisions. Section 24 of CGST Act, it provides for mandatory registration. So, 24(9) says a person who supplies goods or services or both, not covered under Section 9(5). We'll come to Section 9(5) in few minutes later. Through such e-commerce operator who is required to collect TCS under 52. TCS also will be dealing it separately. So a person who is supplying goods or services through an e-commerce operator is mandatorily required to be registered. So, this, if we see this provision, it seems to be a bit harsh. For example, if you have a person who's dealing in goods physically, like selling from a store, and has turnover of say around 20-25 lakhs, he is not required to take registration because he is below the threshold limit of 40 lakhs. But a person who has a turnover of say around 20 lakhs from his stores and say around even 1 lakh rupee of sales from an e-commerce operator, then he would be covered under this provision. So there seems to be some disparity. But realizing this, government has made some amendments which will come down in a few minutes. And second, every e-commerce operator who is required to collect TCS under 52, they are required to take compulsory registration under GST. So as we discussed, government realized that, no, this mandatory registration would be a bit harsh on the suppliers who are providing goods or services through e-commerce. So in November 17, they came out with a notification where they clearly provided that supplier of services who are supplying through e-commerce and their aggregate turnover is below the threshold limit, that is the 20 lakhs and 10 lakhs for the specified states. If the turnover is below that limits, then supplier of services are not required to take mandatory registration under section 24. So this was one relief, which came for supplier of services. Then, supplier of goods also started representing that, there's some disparity. We are not at an advantage if we are selling it through e-commerce. So in 2023, they came out with a notification 34 bar 2023, where they said that person who are supplying goods through e-commerce operator, they are exempt from mandatory registration. And then they put up the conditions that turnover in previous financial year and current financial year should not exceed the threshold limit. So, it has to be below 40 lakhs. There should not be any interstate supply of goods. So, all the supplies have to be only intrastate supplies. The supplies are made through e-commerce only in one state, because definitely, as we saw earlier, interstate supplies were not allowed. And the person who's supplying such goods through e-commerce should have a valid PAN. And based on that PAN, he has to declare on GST portal his place of business and obtain an enrollment number. Under the user services module on GST portal, there's an option to generate an enrollment number for this e-commerce operator. So this was the relief which was provided to supplier of goods who are supplying through e-commerce operator, provided their turnover does not exceed the threshold limit. Then next set of provisions came for composition scheme. Whether a person who's supplying through e-commerce operator to an electronic commerce platform, whether he can opt for a composition scheme or not. So we have got section 10.2D and 10.2AC, both are them for composition scheme. And both of them say that, any registered person who's making supply of services through an e-commerce operator, he is not eligible for composition scheme. Earlier, the words goods were also mentioned. So implying that if person is supplying, any goods through e-commerce operator, he was not entitled for the benefit of composition scheme. Now that word goods have been deleted with effect from 1st October 23. So now any supplier who's supplying goods through an e-commerce operator, he is eligible for composition scheme. But any supplier supplying services through e-commerce operator, they are not entitled to benefit of this composition scheme. And the notification 36 bar 23 was introduced, where they have provided procedure for e-commerce operator with respect to goods which are being supplied through it by the composition dealers. So what they have stated is that as composition dealers, we all know that they are not allowed to make any interstate supply of goods or services. So that is the first condition which is imposed on them. And then the second condition comes that, yes, if the goods are being supplied through e-commerce operator, they are required to collect TCS under section 52. So such TCS should be collected, and the e-commerce operator should furnish the details of such TCS collected in its GSTR 8. So this is what was for supplier of goods through e-commerce operator under a composition scheme. So this was the first set of registration related provisions which are there for e-commerce and e-commerce operators. Then coming to the next set of provisions, we have supplied notified under section 9(5) of CGST Act. We all know section 9(1). It's a general levy provision which provides that supplier is actually liable to pay tax. Then we have section 9(3) and 9(4) of CGST Act, which provides for reverse charge mechanism. 9(3) is for notified services for registered reverse charge, and 9(4) is popularly for unregistered reverse charge, where government by notification shall specify on which supplies, unregistered RCM is to be paid. Now, there's a specific provision in the section 9(5) where government has powers to notify the category of services on which the tax shall be paid by e-commerce operator, provided such services are being supplied through the e-commerce operator. So, first thing, this section 9(5), it overrides your section 9(1), which your general provision that supplier is liable to pay tax. Secondly, this is limited only to notified services, which the government will specify by way of a specific notification. Then it does not apply to goods, it applies only to services. And these services are to be supplied through an e-commerce operator. So these are certain things which should be kept in mind while studying this section 9(5) of CGST Act. In such a scenario, the e-commerce operator, all the provisions will apply to it as if he is the supplier liable to pay tax. So this would mean that, he will be the actual service provider sort of thing. He'll have to raise invoices, he'll have to file returns, and he'll have to discharge his tax liability by, applying the correct HSN and the tax rate. So, and then further it goes that, if e-commerce operator, they do not have a physical presence in the taxable territory, they do not have physical presence in India, then they have to appoint a person, an authorized representative, and he'll be the person who will be paying taxes on behalf of the e-commerce operator. And if e-commerce operator does not have any physical presence, as well as it does not have any of the representatives in taxable territory, then again, you have to appoint. So specifically, even if e-commerce operator is situated outside India, and we have got suppliers in India or listed on their sites or on their applications, they'll have to specifically appoint a person here in taxable territory who will be discharging taxes on behalf of that e-commerce operator under this section 9(5). Now, which of these services are being notified under 9(5)? We have got notification number 17/2017. This notification has been amended from time to time. So we'll go through the list, which are there on the screen. First is your passenger transportation by radio taxi, motor cabs, maxi cab, motorcycle, etc., excluding omnibus. Earlier, omnibus was excluded, sorry. And supplier of service can be any person who's supplying these services. So in such a scenario, if you are supplying such services through an e-commerce operator, the e-commerce operator would be liable to pay GST. Typical example of this would be our Uber and Ola, which are, supplying these type of services. Then passenger transportation by omnibus was included. And in supplier of services, they were specific that any person can be a supplier except company. So in a scenario where company is providing transportation of services by omnibus through an e-commerce operator, then company would be liable to pay tax. And if it's any other person, say a firm, LLP, or an individual, then in such a scenario, the e-commerce operator would be liable to pay tax. Then the next services was there for accommodation services, by any hotels, inns, guest house, clubs, etc. And if they are supplying services to an e-commerce operator, then e-commerce operator would be liable to pay tax, provided that the supplier, he is not liable to be registered under GST. So for an example, an hotel, who's having turnover below 20 lakhs is not registered in GST. And if they're supplying their accommodation services through an e-commerce operator, then e-commerce operator would be liable to pay tax. But if an hotel service provider is registered and supplying his accommodation services through an e-commerce, then in such a scenario, the hotel service provider will be paying taxes and e-commerce would not be required to pay tax. Similar provision is there for housekeeping services such as plumbing, carpentering, etc. Typical example would be an urban club, which provides these type of services. We have a similar sort of supplier of services like we saw in accommodation service. It can be any person except a person who is required to obtain registration under GST. So if an unregistered supplier is providing plumbing, carpentering services through an e-commerce operator, then e-commerce operator would be required to pay tax. And last, we have, this restaurant services, which was introduced with effect from only from July 22, where they were brought under this 9(5). If they are providing any services through e-commerce operator, then it is the e-commerce operator who is required to pay tax. Our example would be Zomato, Swiggy, etc. So they are liable to pay tax on restaurant services which are being provided by them. Just an extension of the previous slide. So, just simple examples that have been taken. Cab driver providing transportation services via Uber. Supplier is unregistered. So, yes, e-commerce operator Uber would be required to pay tax, and it's covered under section 9(5). We have a hotel who's providing room through OYO, and that hotel is unregistered. So, OYO would be required to pay tax under 9(5). Lemon Tree Hotels providing rooms through OYO. Lemon Tree, being a big brand, being a big chain, they are registered under GST. So in such a scenario, Lemon Tree would be required to pay tax and not the OYO. It's not covered under section 9(5). Then we have a registered restaurant supplies who are, supplying food via Zomato. And here, being restaurant services, Zomato would be required to pay tax, and it is covered under section 9(5). Now, there is one exception to this. If the restaurant is situated in specified premises, then the restaurant has to pay tax. Specified premises is defined in Rate Notification 11/2017, which says that any hotel charging 7,500 and above for accommodation will be termed as a specified premises. So a restaurant in specified premises. Example is, Lotus Cafe of JW Marriott. JW Marriott charges accommodation services more than 7,500 per unit. So it falls under that specified premises category. Restaurant being in a specified premises, and for example, they are, providing parcel services through Swiggy. So then in such a scenario, the restaurant would be liable to pay tax because an exception has been carved out. So a restaurant in a specified premises would be liable to pay tax and not the e-commerce operator. And the last example that we have is a carpenter providing services to Urban Clap. He is an unregistered person. So in such a scenario, Urban Clap being the e-commerce operator, they would be required to pay tax under section 9(5). The important criteria under 9(5) is that the services have to be supplied through the e-commerce operator. The word through is important. If you are able to substantiate the facts that the services are not being supplied through e-commerce, then section 9(5) is not applicable. And in such a scenario, e-commerce operator will not be liable to pay tax. It would be the supplier who would be liable to pay tax. So in Karnataka, we had 3 advance rulings, who had gone to advance ruling authorities, 3 applicants, stating that, our services are not through e-commerce operator. And we'll see, what advance ruling authority has said. First is your Just Pay Technologies. They have an application called Nammayatri. It's a technology for auto drivers who can come on this application to provide services. And the Nammayatri app charges them a monthly user fee or a subscription fee. So they stated that they are a service provider hubs. They do not monitor any of the rights. The fare is also not being collected by Nammayatri app. It is being directly collected by the auto driver. Further, they are not responsible to suppliers for non-receipt of payment. So if the auto driver does not get any payment from the end customer, then Nammayatri is not responsible. And even Nammayatri is not responsible to the customer for any deficiency in services by the auto driver. So based on these facts, the advanced ruling authority held that the services of these auto transport the auto rickshaw transportation services, they are not being provided through e-commerce operator, and hence provisions of section 9(5) will not be applicable. So this was the first ruling which was given by Karnataka Advanced Ruling Authority. After this, Rapido went to the Advanced Ruling Authority. It gave its own set of facts that yes, we aggregate cab service providers. we charge a monthly subscription or a user fee from them. We are also a service providers hub. We are also not responsible for any dispute between the drivers and customers, but we have our own variation. We display standard fares, that can be varied by parties. So, for example, if I'm a customer on Rapido and the fare is say around 500, I can vary it to 450, 400, 475, whatever I feel so. Second, they share the pickup location and the drop location through the application. They they help, they give the notification that ride has commenced, ride has ended through this application. They display the entire route to the driver through this application. And they also have an additional facility of SOS or customer call support. So, on this brief set of facts, the Karnataka Advanced Ruling Authority held that no, boss, your services are being provided through your Rapido app. So, you are very well covered under Section 9(5), and you are the person who is liable to pay tax on these services. The next one was Uber India System, who again went to an advanced ruling in Karnataka. They said that, yes, we connect driver with users and we also charge fees to the drivers. We are also service providers hub only. But the additional set of facts were that based on distance, the Uber app provides for the fare. They provide the start and end location. They also show how much amount is to be paid. Ride tracking is available, and also it provides a platform for communication. So here also, based on these set of facts, the Advanced Ruling Authority held that your services are being provided through your Uber app, through your Uber, this application. It is being provided through e-commerce operator, and hence provisions of 9(5) would be applicable, and you will be required to, discharge tax liability on services which are being provided. So, in all three of this advanced ruling, which has come from Karnataka, they have referred to the definition of word through in the Merriam-Webster dictionary, and they said that this is a function word which indicates means, agency, intermediary, etc. So it's like by means of, by agency of. It is all, this word through, it also indicates the extent and period of time, such as during the entire period from beginning to the end. So what they held is that, when you are reading this section 9(5), it should read that services are supplied by means of, or by agency of, or from beginning to the end, or during the entire period by the e-commerce operator. They had referred to this, specific definition from Merriam-Webster, and then they concluded in, three sets of facts which were there before them. So this is, very important that every e-commerce operator should, at least analyze whether services are being supplied through them or not. And also one question that needs to be answered, or, which, eventually clarification should fall out from GST Council, is that mere collection of consideration by e-commerce operator, whether that would amount to services being supplied through e-commerce operator or not. Because with the ever evolving business model, we actually need suitable clarifications for this. So, this was brief on the, on the provisions which were there for 9(5). Now on the procedural aspects that, that e-commerce operator should comply, when their services are falling under this 9(5). This services, the turnover has to be considered in aggregate turnover of the supplier and not the e-commerce operator. Mind you that e-commerce operator is merely paying taxes on the transaction, but the supplies are that of the supplier, and it will be calculated in the aggregate turnover of the supplier. Invoices are to be raised by the e-commerce operator. This is very well clarified in point number 10 of Circular 167/23 by 2021. This circular was issued when restaurant services were covered under this 9(5). Another clarification is that e-commerce operators who are supplying restaurant services, they have to pay 5% purely in cash. They cannot utilize ITC. But they said that, the e-commerce operator will not be required to reverse any proportionate ITC. This is because, restaurant services, as we know, they are required to pay tax at 5%. They cannot claim any corresponding credit. And the notification number 11 says that when you are supplying services at a concessional rate without ITC, then you have to consider it as an exempt supply and reverse your proportionate credit. So e-commerce operator like Swiggy, Zomato, they went, when this 9.5 was introduced for restaurant services, that was, we are paying 5% GST. So whether proportionate ITC or common ITC would be required to reverse or not. So they said, no, you are just paying the taxes. You are not required to reverse any proportionate credit. But yes, you have to be sure that 5% is being paid in cash. Now reporting, table 15 of GSTR1 was introduced, where they said that e-commerce operator would be required to report all these supplies under 9.5 in a detailed manner. So in case where the supplier as well as recipient of services are registered, the reporting has to be done by e-commerce operator at an invoice level. If the supplier is registered, but the recipient is unregistered, then reporting has to be done at a supplier level and a place of supplier and rate wise. Next is where your supplier is unregistered, but your recipient is registered. So you do a reporting recipient wise, but at a document level. What you give the GST number of recipient and then put up the documents which are there. And the last is where the supplier as well as the recipient are unregistered. There the reporting has to be done place of supply wise and the rate wise, and accordingly the taxes have to be paid. So this was introduced in GSTR1. And then they said based on this reporting of GSTR1, the details will be auto-populated in table 3.1.1 of 3B, where, the e-commerce operator will disclose that, what is the value of supplies made through it under 9.5 and on what value the tax is to be paid. So this was the procedural aspects. Coming to some, few basic examples under this 9.5, I have taken an example where the e-commerce operator, it may be in India or outside India, and it is providing hotel accommodation services through its website or application. And hotel is in India. A customer being in India, he books this hotel through an e-commerce operator. The operator will be charging him the convenience fees, and the e-commerce operator will be charging commission to the hotel. So in this backdrop, we'll see, what GST implications would be there. If say hotel is registered, then it is outside 9.5. We have seen this few minutes back in the slide. The hotel is registered, like the example of Lemon Tree which I gave. So then they'll have to pay GST. If the hotel is unregistered, then it will be covered under 9.5. E-commerce operator will be liable to pay GST. If the e-commerce operator is situated outside India, then he'll have to appoint a representative in India, and person who will be paying GST on behalf of the e-commerce operator. E-commerce operator will raise commission invoice on hotel, and if they are in India, they'll pay GST. One question which one may ponder is that, what if the commission is being paid by an e-commerce operator to an e-commerce operator who is situated outside India? We all know that place of supply of intermediary services is place where the intermediary is located. If we say that the e-commerce operator is situated outside India, the place of supply falls outside India, then there can be a good argument that this tax should not be on this tax should not be payable under reverse charge by the hotel, as the place of supply falls outside India. But counter argument from department can come that, boss, you are appointing your representative in India, so you have a presence in India and you pay tax. The services are being provided from India itself. A counter to that can be that this representative is appointed solely for the purpose of 9.5 for paying taxes, nothing else. So, the supplier still continues to be the e-commerce operator who is situated outside India. Commission is paid to such e-commerce operator situated outside India. And since intermediary is outside India, place of supply is outside India. So this is a simple example of an hotel service provider providing through an e-commerce operator. Next example is that of restaurant services. They are supplying food items to delivery partners to customer. Customer would be, placing the order on the e-commerce operator and paying the amount, the basic value plus GST to the e-commerce operator. E-commerce operator in turn would be charging him the convenience fees. And the e-commerce operator, whatever amount he has collected towards food item, he would be paying it to the restaurant, and then they would be charging separately commission to the restaurant. The GST implications would be, if the restaurant is in specified premises, like the one, Lotus Cafe example that I had taken in JW Marriott. If it's in a specified premises, the restaurant is required to charge and pay tax. It is not under 95. If it's a non-specified premises, e-commerce operator is required to pay tax at 5%. The convenience fees, being a separate service, would be taxable at 18%. And they'll raise an commission invoice on the restaurant, and there they'll pay GST on that. So this was, a set of provisions relating to Section 9(5) of the GST Act for e-commerce operator. Coming to the next set of provisions that we have for e-commerce operator is the TCS provision. Section 52 provides that e-commerce operator, they shall collect an amount not exceeding 1% on the net value of taxable supplies made through it. And the important criteria is that the consideration has to be collected by e-commerce operator. So yes, you have to collect 1% net value of taxable supplies, which is defined. It says the aggregate value of taxable supplies other than 95, which we have seen earlier. So you exclude that 95 supplies, less the value of supplies which are returned to the supplier. So your gross minus your returns is your net value of taxable supplies. So obviously, as the word says, taxable supplies, these provisions would not apply to non-taxable supplies, if any, being made through e-commerce operator. If the supplies are being made by an unregistered person, then TCS provisions would not apply. And if the supplies which are made are exempt from tax, then TCS provisions will not apply. So rate of tax is 0.5% in totality. So if it's IGST, then it's 0.5%. And if CNS, 0.25, 0.25 each. And this was reduced from July 24. Earlier, it was 1%. So tax has to be collected in accordance with the tax charged on the invoice. So for an example, you have an e-commerce operator situated in Maharashtra. And on that, on that platform, you have supplier as well as customer from Gujarat who are doing a transaction. So the supplier would be charging local tax, CGST and SGST. Now, e-commerce operator being registered only in Maharashtra would be in dilemma to, collect TCS of CGST and SGST of Gujarat. So on this, they have clearly clarified that e-commerce operator has to take registration in each state where it supplies the goods or services. So wherever e-commerce operator, the transactions are taking place in states, they'll have to have registration limited purpose for collecting TCS. And if you don't have a physical presence, it's fine. You declare your head office in another state as your place of business. And this was clarified by their FAQs in 2018. Now, what has happened, we have a client who's an e-commerce operator and registered in the state of Haryana only for the purpose of collecting TCS. They have declared their place of business in Maharashtra as their place of business in Haryana in accordance with this FAQs. Last month, we have received a notice from a local Haryana officer stating, sir, you have, taken registration based on Mumbai premises. We are cancelling your TCS registration. And, he literally cancelled TCS registration. The client had to travel all the way to Haryana. It was there in, some of the local village. And then he explained, this entire provision and this FAQs to the officer. And after which he was convinced and said, sir, I'll restore. And, last week only we have been able to get that registration restored. So in spite of having such, FAQs on place, we are still facing practical difficulties at the ground level. TCS, e-commerce operator has to file return in form GSTR 8, and it has to be deposited on or before 10th of each month. And whatever TCS being collected, it will be reflected in your 2A and 2B, and it will flow to your cash ledger. So a snapshot, whether you are an e-commerce, if no TCS provisions. If yes, the next question is whether you are making any taxable supplies through it. If answer is no, TCS not applicable. If answer is yes, Another question comes whether you are collecting any consideration. If answer is no, TCS is not applicable. But answer is yes, then whether you ask another question whether these supplies are under 9(5), which we saw earlier. If answer is yes, then TCS is not applicable because e-commerce themselves will be paying tax. But if the answer is no, then yes, you collect TCS at 0.5%. So this is a brief snapshot of TCS provisions. A basic example quickly we'll run through. Customer in Mumbai places an order of iPhone through e-commerce operator, which is registered in Mumbai. For simplicity, we have taken an example of customer e-commerce operator and buyer seller both being in the same state. Amount is 1 lakh and GST 18%. We presume that 20% is the commission to e-commerce. So first would be invoice which goes to customer. The invoice will be issued by e-commerce, but it will be on the name of the supplier only. So 1 lakh would be the value, 18,000 would be the GST, total would be 1 lakh 18,000. E-commerce will raise an invoice of commission on the supplier, 20% being 20,000 and charging GST thereon. Amount which is to be remitted by the e-commerce operator to supplier would be 1 lakh 18,000 would be the gross which is collected. Less e-commerce has to retain 23,600 towards the commission invoice, and less TCS at 0.5%, 0.25 each on the taxable value, which is 1 lakh rupee. It comes to 500. So the net amount which will be remitted by the e-commerce operator to the supplier would be 93,900. So this is how TCS in a simple scenario would work. Key distinctions between TCS provisions and between 9(5), where e-commerce operator is liable to pay tax. On the first side, we have section 9(5), where e-commerce is liable to pay, and on the second side, we have 52. So first is the nature of provision. 9(5) is a deeming provision where e-commerce is actually liable to pay. Under 52, supplier himself is liable to pay, but e-commerce operator is required to only collect TCS. 9(5) is applicable only for notified services. Government, will issue a specific notification for it. And 52 applies on all taxable supplies which are being made through e-commerce. The liability to pay, as we discussed, is on e-commerce operator. Here, supplier is liable to pay under 52. E-commerce operator is only collecting TCS on behalf of it and depositing it. Now, if a supplier is exclusively, say for example, a carpenter who's providing exclusively services through Urban Clap, then if his turnover is below 20 lakhs, he's not required to take registration. But under TCS provisions, if the supplier, he's required to mandatorily take registration unless his turnover is below the threshold limit. Here in 9(5), e-commerce operator will be filing 1 and 3B for notified services, whereas in 52, e-commerce operator will file only GSTR 8. Here in 9(5), as we discussed, supplier will not be reporting any such supplies. And in 52, the supplies would be forming part of 1 and 3B of the supplier only, and he'll claim the TCS credit. Under 9(5), the rate of tax are the applicable rate, whereas under TCS is 0.5%, which was reduced in 2024. And examples of e-commerce operator, as we discussed, Oyo, Swiggy, Urban Clap. Here on this side, we have Amazon, Flipkart, Meesho. So this is a brief comparison between 9(5) and 52. So with this first, almost around 40 minutes, we'll move to the next sector for the day, which is FMCG sector. Here, as we discussed, the provisions are all same, which we have for all the assessees, registration, composition scheme, ITC. So we'll not be focusing more on the provisions. Here in this sector, we'll be focusing on the issues which are being faced by FMCG sector. So again, a brief background of this FMCG sector. India is a country where, no FMCG player can avoid us. This is because, our middle population, which is much more than the total population of USA. So, this consumer, even the consumption, is on a high, and hence, this is our fourth largest sector in India. It employs around 3 million people, creating a good number of jobs. also growing at a good CAGR of 7 to 9%. So it's a, again, as we said, the consumption is on increase. So that is why, this, sector is seeing a good growth. The three main segments of this sector are food and beverages, F&B, healthcare and household, and next is your personal care. So household and personal care would approximately around 50% of the total FMCG, revenue. Healthcare would be in range of 30% and beverages would be around 20%. As we seen, e-commerce also we saw, because of initiatives of government like Digital India, UPI, online users have increased. Here also FMCG, we have seen that, online users are increasing. And here also similarly, the rural spending, on this FMCG sector is increasing. Currently, it is, estimated to be around 45%. So with this brief background in FMCG sector, we move on to the issues that are being faced by this sector. There are around 12 issues which have been listed down. We will be discussing almost majority of them. The first and foremost is selection of an appropriate model. With the invent of GST and free flow of ITC, they need to sit down and see which type of model would be appropriate for them. Whether they appoint CNF agents, whether they open branch offices, or they have warehouses at various cities or centers of India, or they go online and start doing an online business. Next is your multiple rate. We have got 5, 12, 18, 28. So that is also being an issue. Classification is the topmost issue that this sector is facing, always, and at the debate since old excise and customs days. Free samples, whether ITC reversal is required or not, that is another issue that is being there. Return of defective and expired goods. All these goods have a specific shelf life. So post that, what should be the treatment which should be done and what are the GST implications? Various type of discount schemes, pre-supply, post-supply, buy one, get one, what are the implications thereof? Then, you have got brand reminders like diaries, keychains, pens, which are being distributed free of cost, whether ITC reversal is attracted thereof or not. Then you have got target-based incentives which are being provided to dealer. You achieve a certain number of target and you are being given gifts. Whether they are technically termed as gifts or not, whether ITC should be reversed or not. Then manufacturing laws, it's been there since erstwhile laws. We have been seeing deliberations on this, but position now seems to be more or less settled for manufacturing laws being faced by, during the manufacturing process. Next would be the loyalty points and vouchers. Quite a few FMCG players have started issuing loyalty points. The more you purchase, the more you're entitled to. So how the GST implications thereof should be. And the last is the cross-charge versus the ISD. ISD has been made mandatory from April 25. This it's in itself can be a topic for hours and hours, and debate can go on that. What should be cross-charge, what should be ISD. We have got circular on internally generated and services and externally procured services. So these are some of the issues which are being faced by the sector. I would like to run through majority of the issues in next almost around 30-35 minutes that we have on hand. So first, as we discussed the appropriate model, there are various models which are available to an FMCG player. He can have branches in multiple states. He can appoint CNF agents. He can have his own marketing company situated somewhere in the, somewhere in the like tier 1 or tier 2 cities. He can directly engage in retail trade. He may have some franchise model, or he can sell through online, through an e-commerce operator. This is because we have got free flow of ITC in GST regime, and it gives them the liberty and flexibility to select the appropriate model. But whenever you are opening your multi-state branches, you have to be sure the provisions of cross charge and ISD get triggered. Where you're appointing your CNF agents, we have got Schedule 1, where you're supplying through an agent, where agent supplies on behalf of principal, Schedule 1 deeming provisions are attracted. So all these, things have to be kept in mind while selecting an appropriate model. And, one should not only from the feasibility aspect, but from GST aspect also, all these models should be evaluated critically. The first, GST issue that this sector actually faces is, multiple tax rate. We have seen rate rationalization being, there in the agenda of GST Council. Each and every meeting, they try to rationalize rate. They try, that, whatever rates can be lowered, they are trying to achieve that. So multiple rates, 0%, you're nil rated, 5%, 12%, 18 and 28. So the players in FMCG sector have to be constantly on their toes. They should be aware of the rates that are being prevalent, what are the changes that have been introduced. But average rate on their FMCG products is around 18 to 20%. And this has come down, from the erstwhile regime where you had an excise or a VAT being levied, from 20 to 24%, it has come down to 18 and 20%. But now what happens is, I have taken an example where, there's a different tax rate based on packaging of commodity. So say you are just supplying water, it does not attract GST. It's nil rate of tax. But if you supply the same drinking water in a 20-liter bottle, it attracts 12% of GST. And if you're supplying water, including your natural waters other than drinking water in 20-liter bottles, then it attracts 18%. So same commodity based on different type of packaging is attracting different rate. So the players have to be really aware of these rates and the changes that are being brought by the GST Council. And as we discussed, Council is constantly working on this rate rationalization, and we have seen that government is trying to merge certain slabs also. They are in talk that whether if they are in a position to merge 12 and 18% or 18 and 28% altogether. So this is, the challenges that are being faced on multiple tax rates. The next set is pre-packaged and label goods. So before July 22, there was an exemption if you are, selling grains, etc., when it is not branded or the right on the brand is being forgone by the supplier. So if it was a branded, branded grains, then it would be taxable. If it's a non-branded, then it is not taxable. Now, what happened? Taxpayers, they started selling these products by just putting their name on it and saying that this is an unbranded, only the name has been put up. So authorities started arguing that no, this is an actionable claim or an enforceable right. And, the brand, it's still a brand in itself. So it should be taxed. So then, what did the council came out with, an amendment in July 22. They said nothing doing this. Any goods that are pre-packaged and labeled, that will be liable to GST. And any goods which are not pre-packaged and not labeled, they will not be liable to GST. So pre-packaged definition as per LMR, or the meaning that we can derive from the legal metrology rules and acts, commodity has to be in packed condition and such packaging should be done in the absence of purchaser. It should be sealed and the predetermined quantity should be mentioned on such packages. Meaning of label as per LMR was, label means any written, mark, stamp, printed or graphic matter which is being affixed to or it is appearing on this. So generally, the declarations that are required to be mentioned on pre-packaged and pre-label goods are name and address of the manufacturer, name and address of manufacturer and the packer. Importer, if it's there, then importer details have to be mentioned. Common or generic name of the commodity also has to be mentioned. The name, number of quantity also has to be mentioned on the product. The month and year in which commodity was manufactured is also to be mentioned. So these are the conditions which have been put down in pre-packaged and label goods. But there are certain exceptions to this pre-packaged and pre-label goods. So, there are rules, legal metrology package commodity rules, which says that, these type of declarations are not required to be borne on following products. Packages of commodities containing more than 25 kgs or 25 liters. So declaration is not required to be mentioned thereon. When you are supplying to industrial or institutional consumers can be like transportation, railways, airways, hotels, etc. Industrial consumer can be, anyone who buys packaged commodities from manufacturer for use in that particular industry. So if you are supplying to them, then you are not required to bear any declaration. Then we have Rule 26 of legal metrology rules, which says that if the weight is below 10 grams or 10 ml, then you are not required to bear any declaration. Any package which contains fast food. So, all these are exemptions which were there. So, summarized position which came, after this amendment in 22, if item is pre-packaged and labeled and weight is less than or equal to 25 kgs, then it would be taxable. If item is pre-packaged with more than 25 kgs, but it is not labeled, with less than 25 kgs, but it is not labeled, it would continue to be exempt. If it's pre-packaged and pre-labeled where weight is more than 25 kgs and you are not required to bear declaration as per the rules that we saw, it would be exempt. If it's supplied to an industrial institutional consumer, it is exempt. If you have a wholesale package more than 25 kgs and it does not contain any pre-packaged and label items inside it, then again exempt. If your wholesale package is about 25 kgs and it contains your smaller retail packages inside it, which are pre-packed and pre-labeled, then it would be taxable. And if you're selling it in loose, unpacked scenario, then it would continue to be exempt. So this is what, they got pre-packaged and labeled goods, like items like curd, honey, or all of these, if they are not pre-packaged and labeled, they are not taxed. But if they are pre-packaged and pre-labeled, then they are being taxed. Even, wheat, rye, barley, oats, etc. All of these are being covered in this. So, you have to be very sure. If you want to claim exemption, it has to be, either the weight has to be about 25 kgs falling in those exemptions of the LMR, or it has to be, it cannot be pre-packaged and pre-labeled. So, that exemption benefit can be continued. The next big issue that this industry has been facing is classification issue, cosmetics versus medicament. This would be relevant for healthcare sector as well. So general this rate for medicaments under Chapter 30 is 5% or 12%. It's a lower rate of tax, and cosmetic products is 18%. So cosmetics, there's a specific definition. Any article which you rub, pour, or sprinkle and on the human body or part thereof, which is for the purpose of cleansing, beautifying, promoting attractiveness, or altering the appearance. So this is, the definition of cosmetics. It is only for improvising the appearance or for cleansing or beautifying of that body or of human body or any part thereof. Medicament, it has not been explicitly defined anywhere. So, you have to take its common parlance meaning. It's a substance which is generally used for medical treatment. So, a cosmetic product, as we saw, is only for improving the appearance, whereas a medicinal product is to treat some medical illness. Obviously, there is no straitjacket formula for classification. And these disputes have been there since erstwhile Central Excise and Customs laws, and we can take jurisprudence which is available therein for appropriate classification. So I've taken 2-3 examples. Here, first case was of Shri Baidyanath Ayurved Bhavan Limited, where they were trying to classify Dant Manjan as a medicament, and they were trying to claim, the lower rate benefit or exemption benefit thereof. The Supreme Court observed that as per common parlance test also, Dant Manjan is a tooth powder. It does not fit anywhere, in a medicament, mindset. And generally, this is not being prescribed by medical practitioner. And, Dant Manjan, you are using it, on a everyday basis. What medicament that you use, it is like, it is not on a everyday basis. It is for a certain specified period of time. So on this ground, the court held that, this product, your Dant Manjan, it would be classified as a, as a as a tooth powder only, and it would be liable to tax at the applicable rates and not a medicament. Next case is that of Ashwani Homeo Pharmacy, where they were trying to classify arnica hair oil. This Homeo Pharmacy had their arnica hair oil and under a medicament, and they were saying that this is not a simple hair oil which is being used on a regular day-to-day basis. This is basically an homeopathic hair oil which cure or prevent the lack of blood circulation to the hair, They help you in hair fall as well, dandruff, headache treatment as well, and lack of sleep. So here, court has gone through various tests, the common parlance tests in a normal scenario, whether this would be an hair oil which everyone would be applying on a day-to-day basis or not, whether drug license is required or not. Here, they were required to have a drug license for manufacturing this hair oil. So, that is also essential criteria for determining whether it is a medicament or not. The ingredients of this hair oil were found in homeopathic books as well. So, homeopathic ingredients were being used to prepare this hair oil. And just because, the authorities argue that it is easily available over the counter, anyone can, buy this. So, Honorable Supreme Court clearly held that just because the product is available because across the counter, it cannot cease to be a medicament. So, applying various tests and various, this background checks, the court clearly held that this is a medicament and it would be liable for the concessions which are available there. So again, there are cases of CN's laboratory, and there's one more advanced ruling of Akanksha in GST. For the want of time, we'll not be discussing, but only one thing that I wanted to bring out is that, as we said, there is no straitjacket formula. On facts of each case, you'll have to see various tests to apply, and then you have to classify a product either as a cosmetic or as a medicament. Free samples. Whenever a new company, wants to launch their product, or a company wants to launch a new product, they usually give free samples. We have seen, small samples of shampoos, conditioner, which are being supplied over the counter, when you buy certain products. So sales promotion definitely are being incurred in the course or furtherance of business. But we have section 17(5)(h), which blocks credit in respect of free samples. So it says ITC not available in respect of free samples. So definitely the argument, earlier has been that these free samples are a sale promotions without which future orders are not received. The cost of samples are already factored when you're selling, the remaining products, and hence it is not free. Under erstwhile law, it was held that, it is not a free sample and, SENVAT would have been allowed. In GST, we have this section 17(5)(h), term in respect of, it has been interpreted as on by Honorable Supreme Court in case of State of Madras versus Swastik Tobacco Factory. So if we replace that word in respect of with on, it says ITC shall not be available on free samples. An argument can be that ITC has not been claimed on free samples. ITC is being claimed on raw materials which are being used in manufacturing of these free samples, and hence ITC reversal is not warranted in case you are manufacturing such products and giving it as a free sample. It should be disallowed only when you are purchasing and distributing. That is, you are doing trading of items. And even if you say that, no, you are required to reverse under 17(5)(h), what is the mechanism available? When I, say manufacture one free sample of a shampoo or a conditioner, there are various raw materials going into that. How do I compute that reversal? So, an argument can be that since there is no mechanism provided, then levy should fail. We have a very celebrated judgment of B.C. Srinivasa Shetty under income tax. Coming to next, someone would say, sir, entry 1 of schedule 1, it says permanent transfer or disposal of business asset where ITC has been claimed on such asset, that is a supply and you have to pay GST on that. Again, your argument can be where ITC has been availed on such assets. ITC is not being availed on free samples per se, it is availed on raw materials. So hence reversal is not required. And second argument can be that was this free sample, it cannot be termed as a business asset per se. It is something which is going to be expensed out in your books of accounts. So hence it cannot be termed as a business asset. So this was with respect to free samples. The next is return of expired products. As we discussed, FMCG products, they have a defined shelf life. Once these, FMCG products, their shelf life is over, they have to be, either destroyed or they have to be disposed. And generally, we have seen that, these products are being returned by wholesaler or retailer to the manufacturer, who then in turn destroys or disposes them of. So we have relevant provisions. Entry 1 of Schedule 1, which we saw, permanent transfer disposal of assets where ITC has been availed. And second is 17(5)(h). ITC shall not be available in respect of goods which are destroyed, written off. So, if we see entry 1, it says you have to pay tax as an output supply. And 17(5), it says you reverse your ITC as well. So whether this tantamounts to a double whammy on the same transaction, or else one can think of paying tax under Schedule 1 as an output supply and correspondingly say that, ITC reversal is not warranted, or you reverse ITC under 17(5) and then say as ITC has not been claimed, output supply is not payable under Schedule 1, entry 1. Now, this is, if you take a conservative view to pay tax, whether one can take a position that it is neither supply under Schedule 1 nor ITC reversal is required. As we saw, Honorable Supreme Court said in respect of should be treated as on, ITC was always avail on raw materials and not on finished or this time expired products per se. So even my Schedule 1 entry 1 is not triggered because I have not claimed credit on those business asset. And 17(5) reversal is not triggered because I have not claimed credit on free samples. I have claimed credit on raw materials which have been consumed in that free samples. So that can be one argument which can be, thought of. And, maybe we'll have to test this somewhere at the tribunal level or at court levels and see, whether we get a favorable result. On this return of expired goods, there is a circular 72/46/2018, where the department said either you treat it as a fresh supply when you are returning it back. If you treat it as a fresh supply, if it's a normal taxpayer, he'll issue invoice with GST. When the goods are moving back the supply chain, you issue an invoice, the recipient is eligible for credit. If it's a composition taxpayer, you issue bill of supply. Obviously, tax has to be paid, but tax, it cannot be claimed as a credit of the supply chain. And if it's an unregistered person, it would only be a commercial invoice, no GST. So in such a scenario, they said that manufacturer supplier, when the goods finally reach them, if it's the first scenario where regular taxpayer is charging GST, on this return, ITC on return goods have to be reversed by manufacturer, because at the last stage when wholesaler gives the goods back, the expired goods back to manufacturer with an invoice, the manufacturer should claim credit and then they should reverse it. That this is what the circular says. Only one needs to check for compliance under the Drugs and Cosmetic Acts, which, there are some prohibitions for issuing invoice for selling this expired goods, whether that can be done or not. But this is what GST circular says. The second option is you return by issuing a credit note. So when you are returning it by issuing a credit note, we all know it has a time limit under section 34(2), which is, the October period after the financial year ends. So if it's within that time limit, you adjust your liability on the credit note and it will be declared on the common portal. If the time limit is beyond 34(2), there cannot be any adjustment on credit note and, there will be no adjustment of GST liabilities thereon. And here also again it said that once the goods are being returned back, the ITC which is attributable to manufactured goods needs to be reversed. So this is what the circular in substance says about return of expired goods. Next is the discount schemes that we have. Section 15(3) speaks of this. Discounts under GST are usually classified as pre-supply or post-supply discount. 15(1) provides for paying tax on transaction value, whereas 15(3) provides for exclusion of discount from this taxable value. Pre-supply discounts are there under section 15(3)(a). If such discount is known before or at the time of supply and it's duly recorded in your invoice, then you can claim the benefit of it and pay tax only on the net amount, that is your gross minus the discount. Now there will be scenario where you are giving post-supply discount also after your supply has been effected. So there they have put up conditions that this discount should be established in terms of an agreement which is entered prior to your time of supply. This discount needs to be linked to relevant invoices that have already been issued earlier. And ITC on this has to be reversed by the recipient, because when you have, say, charged on gross when invoice was raised, he must have claimed the credit. Now you are claiming adjustment of discount, issuing a credit note, you will be reversing your output liability. So correspondingly, the recipient should also reverse their ITC. So if these conditions are satisfied, adjustment of discount is possible. Pre-supply discount, trade discount, special discount for advance payment, etc., bulk purchase discount. So, all these are your pre-supply discounts. They have to be recorded on invoice. Post-supply discount, if discount is made within stipulated time period, if your yearly targets have been achieved, on all these are your post-supply discount. Documents can be, sales invoice, agreement, brochures, communication, all of these can be used so that, on that basis, you can say that, this was actually agreed when the goods were being supplied. The terms of discount have to be clear. Availability of discount, what is the nature of scheme, condition for entitlement. You just mentioned that event linked to a discount. So, purchase target is communicated. That I don't think would, actually mean that terms of discount are communicated. Mere mention that, a recipient is entitled to discount, say blanket circular announcing, you are entitled for a discount without giving any specific details, that would not be a pre-agreed discount. So that needs to be kept in mind, when you are adjusting GST on post-supply discount. So, some examples that I've taken is, say, for example, buy more, save more offers are there, get 5% discount on purchases worth 15,000 and 10% on this. So yes, this is a pre-supply discount, where you can adjust the GST liability. It will be recorded on invoice as well. Quantity-based discount, based on purchase made by distributor. Say, you are purchasing 200, 500 boxes in a particular period, you get 2%, 5% discount. Though post-supply discount, but agreed at the time of supply, and hence, it would be eligible for credit, for adjustment of GST. Then we have got buy one, get one schemes. Whether, you buy one product, you get another product free. So, whether these buy one, get one schemes, whether it's a single supply or whether you are providing two supplies for one consideration. So it may appear, that one item is being sold free. So in fact, it is not the case. There it is a case where two products are being sold for a single price in such a scheme. So I would say it is two supplies for one consideration. And when you say it is two supplies, you have to check whether it is a composite supply or a mixed supply. If it's naturally bundled, supplied in ordinary course of business, then yes, it will be a composite supply. Applicable tax rate would be that of principal supply. But if you say no, it's a mixed supply, it is not naturally bundled, not a composite supply, and obviously, it is being sold for a single price, then the tax rate of the, the item which attracts the higher tax rate, that would be applicable to your bundle. So, buy one, get one variations are there, where say you get quantity discount, say two boxes are free if you purchase 10 boxes. So it's just a variation of this, similar to what we discussed in the earlier slide would follow. Now, this is also, an issue where advanced rulings are there, multiple on this, freebies or target-based incentives. Freebies are like your brand reminders, diaries, keychains, pens, etc., just for brand visibility, which are given. And then you have got target-based incentives, like, for example, in a particular period, say Diwali period, if your retailers are or wholesalers are achieving, say, volume-based targets, or they're purchasing certain amount of products from the manufacturer, they give all of these target-based incentives. Gold coins are given, TV, fridge, there are foreign tours which are being done. So in this scenario, first question arises whether this is a supply or not. Whether there's a barter that, something that retailer is doing for you and in turn you're providing. So in my opinion, it is not a barter. The consideration is not agreed upon. It's uncertain consideration. And here you're acting on a principal to principal basis. The retailer or wholesaler is actually doing business for himself and not for us. He also wants to earn. So, in my opinion, this will not be a supply under Section 7. Then whether entry 1 of Schedule 1 attracts, you are permanently transferring or disposing your business asset. Say gold coin, you are giving, whether, and you will be availing ITC on that. So whether, entry 1 will attract. In my opinion, it should not, because all these type are directly being expense out. None of them is being routed through business asset or through your asset or balance sheet items. It's directly a debit to P&L. And last, the main question is whether ITC reversal is required under 17.5H. It says, where you're disposing by way of gifts or free samples, ITC reversal is required. So, whether this amounts to gift or not. Gift, we go to the dictionary meaning, it says something which you give voluntarily out of love and affection without expecting any compensation in return. That would amount to gift. Gift Tax Act, which was abolished, it says that, something which is given voluntarily and without consideration. And there is a case law under, Gift Tax Act also. So, in my opinion, whatever these freebies are being given to dealers, that is not given as a gift. It is not something which is given voluntary. When you're giving gold coin, when you're giving tour, when they are being entitled for tours, also, you are giving some products to them on achieving certain targets. It is not a gift. It is not given voluntary. It is, you'll be generally giving brochures, or, you'll be putting up emails, will be putting up scheme documents. So based on that, you are giving that. It is not something out of your love and affection. In my humble opinion, it will not be a gift, and hence ITC reversal is not warranted. But when we talked about brand reminders, when you're giving that freebies like diary, pen, keychain, even though it is for your business, you're promoting it. In my humble opinion, it would be, it is being given voluntary without consideration, though not out of love and affection, but yes, it is still voluntary and without consideration. So in that, there are good chances that department may come and tell you to reverse such credit. So there are a number of advanced rulings. I'll not be running through them to want of time. The PPT will be circulated and you can refer. But in substance, all these advanced rulings says that even if you have target-based incentives being given to your dealers, still the credit would not be, entitled. It would be a gift and it would be blocked. We have not got any court ruling, no tribunal rulings, and this matter needs to be tested at a higher level, whether this is actually a gift which is being given, because there are no free lunches in business, as we all know. Manufacturing loss, whether you are required to reverse any credit, whether it actually means good lost or not, whether good lost has to be seen in its natural sense, or, because manufacturing loss is something which is very normal. There are always, there are 1, 2, 3%, of inputs or raw materials which are lost in, during the course of manufacturing process. So in the erstwhile era, we have got judgments, from tribunals that, this is not, this should not be seen as a loss. Whatever quantity, say 100 minus say 2%, 98 quantity goes of raw material. Whatever output product is being produced, that is, output of the entire 100 units as such. And, hence any reversal is not warranted thereof. And we have a judgment in GST as well, ARS steels and alloy, where it says that, any loss of consumption of input, which is inherent to manufacturing process, that should not be contemplated or covered under this section 17.5H. They are not actually lost in their real sense. Loyalty points and vouchers. This loyalty points and vouchers, we have seen number of schemes which have been coming up, and, various FMCG players are, promoting this scheme so that you can encourage more and more buying from the customers. So whether, entire, this loyalty points can be redeemed when you're buying your, when you're buying next time, or, at the second purchase that you're doing at that particular shop or store. So whether, it can be termed as a discount or not. So there are good chances that, when you are, say, redeeming your points, say 100 minus 10, 10 of, say 10 is your loyalty points which you can redeem. Good chances to say that, it is to be netted off, and GST is payable only on 90 rupees. And if not, whether issuance of this voucher, whether it can be termed as an actionable claim or not, because it is nothing but a claim to a debt. That voucher or gift card, they represent the value which is due from that, it can be redeemed to that store. So, it can be treated like a pre-deposit instrument in nature of an actionable claim. or as a means of payment, and hence it should not be issuance of that voucher should not be taxed. So with this, I would just like to conclude, with a small remarks of Justice J.B. Pardiwala, when he had remarked this to Government Council, that it is very easy for us to reach to moon. If someone would say, whether you like to take a trip to the moon, definitely you would like to take a chance. But to understand your policies and your intricacies of GST, oh God, with folded hands, it is beyond our capacity to understand. With this, I would like to conclude my session. I thank each and every participant for a patient hearing. Thank you so much. Over to you, Bishan sir, Ketan sir.
Jinesh bhai, it's over.
Yes, sir.
Any questions are remaining, sir?
You had given me time till 7, so I tried to give it a marathon session and complete it by 7.
Yes. One of your friend is also here.
Hello, sir. How are you?
Jinesh bhai, Bishan bhai.
So he's our helping us on trust matter of ICA. So he was coincidentally here.
He's
So
the
this
best
question
person
which
for
is
that.
there, can
Sir,
somebody?
yeah, Dharmesh Taylor sir has asked one question. Can you please share your views on following? Supplier A supply goods on Amazon. Amazon allowed some discount to customer. Treatment of GST in the hands of the supplier A and Amazon.
So
Second,
this,
yes.
okay. Should I
Second,
take?
so you take first this question.
So if this discount is already listed out on Amazon, before buying the product, if I'm well aware of this discount, then the supplier can take a deduction of this. Say the value was 100 and discount of 10% was put up on the e-commerce platform. So only on 90 the GST would be payable. And in case the Amazon is reimbursing this discount, there are e-commerce operators who reimburse these discounts to the supplier. So then if this is being reimbursed, this would be an additional consideration which would be flowing to the supplier, and then that would be liable to be taxed in the hands of supplier.
So now second question is Amazon contracted with bank for allowing discount. Treatment of GST in hands of supplier and Amazon.
So that would be the same, as
Same.
we discussed. Yes.
And the third scenario is supplier and bank contracted for discount. Supplier allowed discount on use of bank credit card on behalf of bank. Supplier recovered 50% of the discount from bank. Treatment of GST in the hands of supplier on sale of goods and on recovery of discount.
So when goods are being sold and discount is specifically mentioned, you can take that, when you're raising an invoice on the customer. But if you are recovering that discount, consideration, this consideration would mean payment from the recipient or any other person. So, when you are recovering this discount from the bank, it would amount to a consideration and it would be liable to GST.
So I guess you have covered the sector which has been entrusted to you crisply, smartly, and very efficiently. And so far as the composite supply of this type of session is concerned, we at WRC are very much thankful to you for this deliberation, and I'm thankful to participants as well for joining here and participating in this sector specific webinar. We are going to meet again on next Thursday, same time, with other topic and with the other faculty. So thank you very much. We herewith conclude this session today and request all to join on same time next week again. So thank you very much, all and one. Thank you.
Thank you. Thank you,
Thank you,
sir.
Janish bhai. Thank you.
Thank
Bye.
you.
Bye.